What's up guys, Jake here. A couple weeks ago when we ended the dead hand options trading strategy on my channel, I told you that the next time the Federal Reserve Board was going to meet, I would show you a potential trading method that you can make some money in anticipation for the markets kind of freezing up. Now, the market right now is going crazy. When you look at the performance of SPY, which is the S&P 500 index fund, it has been green. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 out of the last 10 days, the entire S&P has gone up. So will this continue? Will there be a pullback? Well, there's been a lot of euphoria this week as we're at the height of earnings for all the tech stocks, Facebook, Microsoft, Google, Amazon, Tesla. Everyone is reporting, and it looks like in the last 2 days, everyone and their mother has bought Tesla. Wow. So the question is this going to continue in the next week or two? How can we short-term play this if we think the market is overbought? Too many green days in a row. And why I believe potentially there will be a small pullback in the market is because the Federal Reserve Board is meeting next week. With all the headlines of Tesla and all the other stocks doing their earnings, people in the market aren't paying attention to the fact that the Federal Reserve is meeting next week. And everybody is talking about how there will be an announcement in the end of tapering. So Federal Reserve Jerome Powell and other top policymakers have indicated over the course of the past month that they are preparing to start reducing the 120 billion monthly bond purchase. Now, just the announcements of tapering, of ending quantitative easing, should cause the markets to just seize up for at least momentarily. When is this meeting happening? You can Google when the Federal Reserve Board meets, and their next meeting is over 2 days, November 2nd and 3rd. So once this week ends and we're through earnings season, corporate media is going to cover this nonstop, and it's going to, in my opinion, cause the markets to seize up again. So what I'm going to do is I'm going to trade a debit spread. So let's do a quick recap of what exactly is a debit spread. If you want to trade vertical spreads, make sure that you're approved with your broker to make a trade like this. Before we go any further, I just need to vocalize it now that this is an extremely risky play. You can lose 100% of your money doing a trade like this. But if you stick with me, it's up to you if you think this is an interesting idea or not. So of the 4 kinds of vertical spreads, 2 are credit spreads, the bear call, the bull put, and 2 are debit spreads. What's the difference? With a credit spread, you're receiving a net payment today. It's kind of like a covered call or a cash secured put, except you're not buying 100 shares of the stock, you don't own 100 shares of the stock. And with a debit spread, you're net paying something today. So it's kind of cheaper than buying a put or buying a call outright. You're capping how much you can make, but it's more affordable capturing price movements. If you want to watch my videos about credit spreads or debit spreads, check out my entire playlist on trading options. I'll link it down below. But let's just review the 2 kinds of debit spreads because that's what I'm going to do in this video in a second. So the bull call and the bear put spread, I feel like the bull call is easier to understand. So let's just talk about these 2, and the bear put on State Street's SPY is what we're actually going to trade. So why do you buy debit spreads? And once again, it's because it's affordable speculation. Rather than just buying a full contract outright, you're going to sell another contract against it to get some of your premium back, basically. So there's a debit for a large amount and then a credit for a smaller amount, and you're basically capturing price movement in a very specific range. So for the bull call spread, let's say you have a hunch that the market or a stock is going to go up in the short term. So you're going to buy a call, and I always do calls just out of the money. And once again, this call can be pretty expensive and you don't want to pay the full price. So you're going to sell a call at a higher strike against it. So this is going to cost you a lot of money. You're then going to get a certain amount of money back on the call that you sell. And if you're right and the share price shoots up, you gain money on the call you bought, but then you're going to lose money on the call that you sold. So you're capping how much money you can make once the share price of the stock or ETF goes above this line. Once it goes above this, you can't make any more money on this trade. Vertical spreads are great because in a way it negates implied volatility. Whatever IV is, going up or going down on this leg, it's also going up or going down on this leg. So in a way they cancel out. It also, to a certain extent, negates theta decay because when you just buy a call outright, the contract premium is shrinking as time runs out. So if you have a contract in the short term, it's really not you're not saving as much money as opposed to a contract that's much farther out. So what is your max profit on a trade like this? It's the width of the spread minus the net debit you're going to pay multiplied by 100. And how do you lose everything? Well, if the share price doesn't get above this line on the call that you bought, then this contract is going to go to zero and this contract is going to go to zero. With a debit spread, you lose everything. So it's an incredibly risky trade. If the share price just trades sideways or goes down, you lose 100% of the money you put up. So what I'm going to do today is buy a debit spread on State Street's SPY, and it's the bear put version because I think the market's going to pull back a little bit. So let's go ahead and review what I'm going to do. And I'm going to buy an out of the money put. So on the put side, out of the money is below where the current share price of the stock or ETF is. And once again, buying a put outright will be expensive. I don't want to buy the full price. So I'm going to sell another put against it at a lower strike. So there's going to be a range, a width. And if the share price of SPY can go through both of these lines and get below this put that I sold, I've capped how much money I can make on this trade. Once again, max profit is the width of the spread minus the net debit I'm going to pay today multiplied by 100. So how do I lose all my money on this trade? Well, State Street's SPY either trades perfectly sideways or it goes up. Additionally, with debit spreads, there is a break-even point. So because this is going to cost me something, if the share price of SPY only goes a little bit down, then I didn't get to my break-even point, and I'll get a little bit of money back, but I'm still basically losing everything. So let's jump into my Schwab account and let's dial this up. I'm going to go over here and click on Option Chain. Now what I want to do is to buy a debit spread that is going to expire on November 19th. The reason why is because it's basically going to give me 2 attempts to capitalize on this trade. The reason for it is the Fed is meeting next week, so if the market panics or freaks out, great, I'll make a lot of money. And additionally, the third Friday of the month seems to be triggering market sell-offs. So if you notice here, July 19th, that's about when the third Friday of the month is. June 18th, the third Friday of the month. Let's see here. We got May 19th, we've got August 18th, and we've got September 20th. So there's something weird going on here where the third Friday of the month is when all of the monthly options contracts expire. And for whatever reason, the market seems to be selling off or seizing up the day before all of these contracts for the month expire. So I intend to purchase this it's a bear put spread and hold it through the Fed meeting. If it doesn't for whatever reason take, I'm going to continue holding it until the third Friday of the month to see if this pattern continues. It'll be really interesting if it doesn't. So let's go with an expiration date. Once again, this is going to be November 19th, the third Friday of the month. And we're going to be on the put side because I think SPY is going to go down. I'm going to choose the closest strike out of the money. So SPY is currently 45665. So let's select 456. And you can go with whatever width you want. I'm just going to choose a width of $5 because those are, it's a width of $500 total. It's easy to mentally track here. So let's scroll up, and you now have to choose which one are you selling to open and which one are you buying to open. With the debit spread, we're going to buy to open the strike closer to the current share price and sell to open the one further away. And on Schwab, it immediately recognizes this is a vertical put spread. That's a debit because it's saying DR 142. If we were to reverse these, this would be an in-the-money put credit spread, which is interesting. And you can look at it. It's now giving me a credit of 140, but I would be thinking the share price would be going the opposite direction that I think it's going. So we're going to flip these back, and we're looking once again at a debit of 144. Let's click trade to finalize this. So here is the review page, and with your broker, ideally they're going to offer you some kind of analytics here. So on Schwab, if you go to trade and probability, what is my max loss? My max loss is $143, i.e. SPY continues going up over the next 25 days. So yes, I'm risking this $143. It will be completely gone. But how much can I make in 25 days on this trade? Max profit, 357. The width of the strikes, 500, minus the debit, 143. I can make $357 in 25 days if SPY just pulls back a little bit. I mean, $5 a share on when the share price is 457. It's basically like a 1% pullback in the market. So what we've done here is we've built one trade, and if all you want to do is maybe test this out and do just one, great. I am going to dial it up. I am going to enter in quantity 10, quantity 10. We're going to switch this to a market order so it fills. Schwab is going to recalculate everything, and it's going to tell me that this trade is now costing me $1,430 to purchase 10 bear put debit spreads. For $1,430, I can potentially make $3,570 in 25 days. So this is a defined risk trading strategy. This $1,400 is the most I can lose. But it's also a very high probability that I'll lose it. In general, markets go up. So I've never actually done a debit spread trade this big before. But once again, I'm just feeling so confident with this Fed meeting coming up, and then just in general the market pulling back on the monthly option contracts date, that if I just hold this until September 19th, that I could potentially make $3,500. I'm willing to risk $1,400 to double that amount and try and get 35. So we're going to go with this trade. I'm going to execute this. And there it is. I've executed in my count. I could potentially lose $1,400 over the next 25 days if SPY stays above basically 456. If it stays above 456 for the next 25 days, I'm committed to losing $1,400. But if I'm right and it just pulls back, the market pulls back 1% from where it is today, I can make $3,000 or $3,500. So we'll do an update potentially if this pans out in the good way for me. If I lose everything, then okay, I'll make that video too for you guys. If you guys like this kind of content, give me a thumbs up so the algorithm knows it's good. If you have any questions or comments about what I'm doing, let me know down below. I love hearing from you guys. Till the next video, take care.